Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we focus on a critical but often misunderstood topic: risk management strategy in investing, building strong portfolios across asset classes. Investing is not solely about chasing returns. It involves understanding uncertainty, managing exposure, and protecting capital while allowing wealth to grow over time. This episode aims to help investors grasp the true meaning of risk management, how to apply it when building multi-asset portfolios, and why it is the key to achieving long-term success instead of facing repeated financial setbacks. Understanding risk management in investing. Risk management in investing is the deliberate process of identifying, assessing, and controlling potential losses arising from market movements, economic shocks, or personal investment decisions. Contrary to popular belief, risk cannot be eliminated in investing. It can only be managed. Every asset class, equities, fixed income, real estate, commodities, or alternative investment, has its own risk profile. The goal of risk management is not to avoid risk entirely, but to ensure that no single risk can significantly damage your overall financial position. At its core, effective risk management begins with awareness. Investors must recognize that higher returns are usually accompanied by higher volatility and that markets move in cycles. Accepting this reality helps investors make rational rather than emotional decisions during periods of uncertainty. Risk across different asset classes. Each asset class responds differently to economic conditions. Equity are typically growth-oriented but can be volatile in the short term. Fixed income instruments provide stability and predictable income but are exposed to interest rate and inflation risk. Real assets such as real estate and commodities often serve as inflation hedges but may be subject to liquidity constraints. Alternative investments can improve diversification but usually come with complexity and higher entry risk. A well-managed portfolio recognizes these differences and uses them strategically. When one asset class underperforms, another may stabilize the portfolio. This interaction is the foundation of diversification, which remains one of the most powerful tools in risk management. Portfolio construction and risk optimization. Optimizing an investment portfolio involves balancing risk and return in line with an investor's objective, time horizon, and tolerance for volatility. Risk management is central to determining asset allocation, the proportion of funds assigned to each asset class. Younger investors or those with longer investment horizons may be willing to take on greater exposure to growth assets, while investors closer to their financial goals may prioritize capital preservation and income stability. Beyond asset allocation, optimizing also involves position sizing. No single investment should dominate a portfolio to the extent that its failure threatens overall wealth. Concentration risk is one of the most common mistakes investors make, especially during bull markets. Gradual investing, periodic rebalancing, and disciplined entry points help reduce this risk. Controls and discipline in investment decisions. Risk management is sustained through controls that guide behaviors, particularly during emotional charged market conditions. These controls include predefined investment limits, clear diversification rules, and regular portfolio reviews. Investors should also set guidelines for the level of exposure they are willing to take to volatile assets and for how losses will be handled if market conditions change. Another critical control is liquidity planning. Investors must ensure that funds required for short-term obligation, emergency funds, are not locked in illiquid or highly volatile investments. Liquidity mismatch often force investors to sell assets at unfavorable prices, turning temporary market declines into permanent losses. Risk management also requires continuous learning and monitoring of information. Economic indicators, policy changes, and global development can shift risk dynamics. Staying informed enables investors to adjust their strategies proactively rather than reactively. How risk management benefits investors? The benefit of risk management extend beyond capital protection. A well-managed portfolio provides emotional stability, enabling investors to stay invested through market downturns and benefit from long-term compounding. It also improves return consistency, reduces the likelihood of catastrophe losses, and build confidence in decision making. Importantly, risk management fosters discipline. Investors who understand their risk exposure are less likely to chase speculative opportunities or panic during corrections. Over time, this disciplined approach significantly improves wealth building outcomes. Getting started with risk management. Investors can begin effective risk management by honestly assessing their financial goals and risk tolerance. From there, they should build diversified portfolios aligned with those objectives, adopt a long-term perspective, and regularly review performance against expectations rather than market noise. Seeking professional advice and using structured investment framework can further enhance risk control, especially as portfolio grow in size and complexity. In summary, risk management is the backbone of successful investing. A successful investment journey is defined not by the highest returns in a single month, but by steady growth over the years. Discipline, structure, and long-term thinking remain crucial. By understanding risk, diversifying across asset classes, optimizing portfolio construction, and implementing clear controls, investors position themselves not only to grow wealth but also to preserve it through market cycles. Thank you for listening. Please join us again next week for another interesting and insightful session. For questions, comments, or feedback, please email to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.